This is FinTech Insider News. This week, Wise makes a bold leap into Africa's booming fintech market. The FCA launches a big push to restore trust in ESG ratings. And StreetSmart, Revolut launches new feature to stop transfer mugging. We'll be tackling all of this and more on today's news show, so don't go anywhere.
When the holidays start to feel a bit repetitive, reach for a Sprite Winter Spiced Cranberry and put your twist on tradition. A bold cranberry and winter spice flavor fusion, Sprite Winter Spiced Cranberry is a refreshing way to shake things up this sipping season. And only for a limited time. Sprite, obey your thirst.
Oh, Hilton stay, your beds are soft and cozy. No lumpy couch, no stiff futon, no shower line at crack of dawn. Oh, Hilton stay.
When you want holiday comfort you can count on, it matters where you stay. Enjoy comfortable rooms and friendly service when you stay with Hilton instead. Save up to 25% this season when you book with Hilton. Hilton for the stay. Terms apply.
Hello and welcome to episode 1021 of FinTech Insider, brought to you by 11FS, the 5-time consultancy of the year that works with banks, investment firms, digital banks, and fintechs to build the next generation of financial services. I'm David Barton Grimley, Director of Strategy and Head of Products here at 11FS, and this week, December is in full swing. And while some may call it the silly season, there's nothing silly about the flurry of festive fintech headlines making the rounds. So helping me spread some of the Christmas cheer on our first episode of the month is today's panel. Shall we meet them then? First up, a welcome back to FinTech Insider for Aditi Subbarao, Financial Services Account Executive at Snowflake. Welcome back, Aditi. I gather you've got a new role since we last spoke. Tell us a little bit more about what you're up to.
Yes, indeed, David. It's been an eventful few months. So 2 months ago, I joined Snowflake, which is the AI data cloud for the enterprise. And you might recall from our previous conversations, in all my time at Instabase, it was so obvious that the biggest blocker to organizations realizing value from AI was the fact that their underlying data estate wasn't AI ready. And that is the problem that Snowflake is looking to solve by fixing that end-to-end stack, starting from data to applications to the overall ecosystem of AI and data users. So I have a fantastic vantage point into it at the moment, and it's all very exciting. Thank you for having me back.
Awesome. Yes, very topical, and big congratulations on the new job. Next up, we have a FinTech Insider debut for James O'Sullivan, CEO and founder of Nuke from Orbit. Welcome to the show, James. Great to have you on. By the way, love the name of the company. It's amazing. We'll talk about that more in more detail. Can you tell us a little bit more about yourself and your role at Nuke from Orbit?
Certainly. Thanks for having me on. My name's James. I'm founder CEO here. We do smartphone security, particularly around financial and data assets on stolen devices. So fairly topical this week.
Yes, lots and lots of stolen devices, which we're going to be talking about in a little bit. Great to have you on board, James. And last but not least, it's a FinTech Insider News return for Virginie O'Shea, founder of Firebrand Research. Great to have you with us again, Virginie. Can you introduce yourself for anyone who might not know you and tell us a little bit more about what you do?
Yeah, sure. Thanks. In terms of what I do, I'm an industry analyst. So I've spent several decades now looking at capital markets, technology and operations. So probably something slightly different to a lot of the other people that come on FinTech Insider. So my realm is all the investment banks, brokers and asset managers and regulators in that realm.
Amazing. Yeah, it's fascinating. We've got a story coming up on that one as well. So yeah, it's great to have you back. Right. We have a panel, and so on with the show. This first story is from FinTech Finance News. HSBC and Mistral AI join forces to accelerate AI adoption across global bank. HSBC has signed a multi-year strategic partnership with Mistral AI to integrate generative AI models across the bank. The deal will let HSBC use self-hosted AI models for a variety of internal tasks, speeding up document-heavy financial analyses, enabling multilingual translation and reasoning, generating tailored client communications, and helping procurement, marketing, and risk assessment teams. By adopting Mistral's AI tools, HSBC expects to boost productivity, accelerate innovation cycles, and roll out new customer-facing and back-end features faster. This partnership emphasizes responsible AI deployment, so both organizations commit to data privacy, AI transparency, and compliant use. So I feel like this is actually quite significant news, right? HSBC is a phenomenally large organization, and so them making a move to embed this properly is big. So Aditi, what does this tell you about the urgency of AI adoption, or just how AI adoption is going generally in banking?
So, first of all, David, I'm going to say I perhaps disagree with you. And this might be a slightly controversial opinion, but think about it this way. I read the story like that of a footballer's transfer, or like some club buying a particular footballer for a very high amount. And lots of newspapers talk about it. It's big news. But at the end of the day, every single club has a team. They have a bunch of footballers. Will this new person coming in make some changes to the team composition? Absolutely. To the way they play football? Absolutely. Is it going to completely change everything and make them a cricket team instead? No. So it's almost like if you look at what's happening in the banking landscape, every single bank, especially if they are like a GSIB or a large multinational bank, has been using and experimenting with AI and working with large language models for a very long time already. Even at HSBC, they recently made an announcement, I think in the autumn, about how they're working with OpenAI to build the wealth intelligence platform. They've been using machine learning models. They have more than 400 use cases in AI, especially in the ML space, already live across the bank. So I see this more as the next step in what they're trying to do. And perhaps, I mean, it may well be akin to, say, Messi finally accepting the Saudi contract in the sense that it is much more aligned with their strategic objectives as opposed to just yet another AI step. And I'll tell you why I think that. But before that, I am obliged to put in this caveat, which is these are all entirely my personal opinions and based on publicly available information. But there's a couple of things to consider here. One is, if you look at the composition of HSBC and the nature of the bank, especially as different from, say, the JP Morgans or the Citis or the Goldmans of the world, it is that HSBC is a massively geographically distributed and also technologically fragmented bank. So they operate in Vietnam, they operate in Egypt, they operate in Mexico, all of which have very different regulations and laws from a data sharing, data privacy, data security perspective. What that means is, in order for them to be able to use AI across the bank, they need to have something which is manageable across those regions, but also established in a smaller format rather than a global cross-region AI platform, which brings us to the self-hosted piece. Mistral's strength has always been small language models. They are the one company that didn't really go on and make their models bigger and bigger and bigger and more tokens and more size of model. They focused on making specialized small language models. And that's where it aligns very nicely with what HSBC requires. The other interesting consideration here is geopolitical. So across the entire AI landscape in the foundation model space, Mistral are the one credible European contender. For a bank like HSBC, again, given its presence in China, given its presence in Russia, given its presence across the world, they need to have somebody whom they can credibly demonstrate both to the market and to the regulator in saying they are respecting all of these complex matrix interconnectedness around the political aspect also. So that may well be one of the reasons why Mistral is a strong choice. And one last thing before I stop. If you look at the use cases that they have highlighted in the article, most of these use cases are around fairly defined workflows. So they want to talk about more efficient loan origination and lending processes. They're talking about translations of specific information from one language into other. When you think of how LLMs operate in this region, when your use cases are broad spectrum, highly unpredictable, large language models tend to do better. So if you're thinking of something like enterprise search across all of your data and you don't know what the question will be, you don't know what the answer should be, a larger language model will do better. Therefore, you need to have it ideally like cloud hosted, managed by an LLM company. When you're thinking of defined workflows, they're predictable, you know what they need to do, you know what the inputs will be, you know what the ideal outputs will be. You can easily manage this through smaller models. And in fact, over time, self-hosted models, which you are fine-tuning with full control, tend to be cheaper, better, faster than the larger models. And that might be another reason that explains the Mistral choice.
Oh, I love that so much there. I mean, I think what you're surfacing here is almost the tension between the different approaches. I mean, like 99% of the approach out there that you see is the big sort of mad compute data sensors, big LLMs growing. But actually, you know, the research that I've done this as well backs up what you're saying is the SLMs when it comes to very specific workflows are where the interest actually is. I think it's so fascinating what you're talking about. It'd be really interesting to see how this big game plays out between the big models versus like, we're gonna specialize on something that's specific for banking. Who wants to come in on this panel? Virginie, James. I mean, what are you both seeing about how this is maturing in banking? Virginie.
I mean, I can certainly comment on the Mistral geopolitics aspect because I was actually, I attended the European Securities and Markets Authority Data Day yesterday. So the European level regulator that regulates all of the securities markets across the EU. And they were talking about Mistral, in fact, being the only viable option for them when they're doing AI, because all the regulators out there are really also trying to use it for subtech purposes, right? So it's not just the banks. So on the regulated side, we're seeing it being adopted, but also on the regulator side, they're trying to learn and get innovative as possible, as quickly as possible. So it's interesting to see how much tension there is and how many worries they have about third country exposure. And Mistral is probably the only shining beacon for them on the AI front that could be used for their purposes. And I imagine they're going to be putting pressure on other banks within the European realm to be using European providers for that very reason. If we look at all of the different regulations, I'm a regulation nut, so I do warn you that anything comes back to FinReg in my eyes. But there'll be a lot of pressure given things like the Digital Operational Resilience Act and all of the other AI Acts and all of these things that are coming in that are putting pressure on banks to act in a certain way. And I think there's going to be even more pressure for people to be using a European variant of or a provider, though we do not have, I guess, a cloud provider.
Because this creates a hell of a lot of opportunity for new businesses to come in and set up some stuff.
Definitely.
Yeah, I think the other thing I think you might be seeing here, certainly with the smaller models, is a slight maturing of the industry. So in the early days, it was throw as much compute and as much data as you can to get something that works. And now we're in a slightly different place where there's not infinite money to keep throwing tokens and compute at the problem. So maybe having a smaller, more fine-tuned, more targeted model will lead to a better business at the end of it when VC eventually decide to fund something else.
Yeah, 100%. I mean, I would love to see, some research that shows how SLM scale in their use cases and how they can be profitable. Is there actual underlying profitability in the compute power required for the SLMs to realize the use cases that they actually do, right? Because this is one of the kind of canonical issues with the AI industry at the moment is that it needs to get to such a phenomenal level of intelligence or AGM or even ASM, which is another word that's being bandied around at the moment, in order to be profitable. Whereas maybe the SLM is saying, well, actually, we can achieve a lot of output with a compute based on the GPUs that are available at the moment at a rate that might be profitable. I have not seen any research that says that. I wonder whether Mistral might have a view on that as well. Really super interesting to see it.
There's research on the sort of the compute power that various regions have. And I think the US is leading, right, globally. It's about twice the compute power we have in the whole of Europe that they have at their fingertips. I think it was a German power company that sponsored research last year on that with regards to data centers. But they haven't done the same this year. They did it in 2024. So it'd be interesting to see how much money has been thrown at it to get us up to speed.
So the other thing there, David, if we were to look at it from a evaluatory perspective, like you say, we're evaluating compute, we're evaluating cost, we're evaluating performance. The other aspect, which is actually a very critical one for banks, is how much control do they have and what is the explainability that they can demonstrate around it. Again, when you bring it back to smaller models, more so models which are self-hosted, self-trained, etc., it gives them a much higher level of both control and confidence in the fact that they know what the model is doing and why it's doing what it's doing. So if you look at it, it is not so much unidimensional or even maybe 2 or 3 dimensional trade-off or choice. There are so many considerations in making that choice from large versus small, cloud-hosted versus self-hosted, and all of those considerations. More importantly, that choice also varies by use case, by definition. Again, like we said, if it is a chatbot, which is just going to be a helpline for all your customers, by all means, go cloud, go large. If it is going to be generating marketing content for you, there's no concerns about data privacy. It's all public. Go open, and so on. But I think the other confusion, which I have often seen crop up in conversations with banks, is they make a natural association between saying that anything which is self-hosted, it's more controlled, and therefore we will be able to manage it better. However, what often gets missed is managing a model is not just about knowing what it's doing, but it is also about updating it, upgrading it, fixing drift, incorporating any new developments, incorporating any defenses to new security threats which you might not even have thought about. And all of that is an immensely heavy task to do. It requires a lot of sophisticated resources. It requires a lot of money. It requires very strategic thought processes around it. And that is something not all banks are equipped to do. So again, long story to basically convey the simple point that this is an extremely difficult decision and it is never one thing or the other.
It's interesting because it kind of mirrors this sort of on-site cloud kind of cycle that software has been going through, you know, and actually, wait, it turns out that there are some serious benefits of using cloud. Virginia, I have a quick question for you on the regulatory side. I mean, are you picking up on any points of view about explainability for these things that the regulators are saying, like the extent to which these things need to be explainable and how that might work?
Yes, I think governance is the single most important thing for regulators when it comes to AI. Understanding where you're trialing it within your firm, understanding the controls, understanding the data that's going into it. Is that where's the data coming from? Are you using generate AI generated data to feed into it? Because some people have gone down that route and that's really quite dangerous. There's a lot of different consultation papers that have come out over the last couple of years from all of the different national regulators and the EU level as well, and the UK for that matter. There's lots of different sandboxes being set up all over the place, and there's going to be even more next year as part of the data union strategy in the EU, and the UK is feeding into some of that actually. Even though the Brexit happened, they're still cooperating with each other on the topic of AI because it is sort of very important from a European perspective, not just EU.
Yeah, it's essential. Look, I'm sure we could keep talking about this forever. It's just such an amazing, topical, constantly changing subject. But for now, we do have to move on. So into the next article, and this one is from Finextra. Revolut launches Street Mode to combat transfer mugging. Revolut has launched a new security feature called Street Mode to help protect users from rising transfer mugging and phone snatching scams. With Street Mode, users define trusted locations, so that could be your home, for example, or your work, I guess, and any fund transfers initiated outside those locations trigger some extra protection, so it could be a 1-hour delay plus additional ID checks before processing. The launch comes amid reports that phone thefts in the UK have surged up to 425% since 2021. That's huge, raising fears that thieves could misuse unlocked phones to transfer money while users are under duress. The feature expands on Revolut's existing security tools to give customers more control and extra protection when they're on the move. So I have to confess, I have never heard of such a thing as transfer mugging. That is a new type of mugging that I have just come across after reading this. James, this is absolutely your area of expertise. What is transfer mugging, and how big of a problem is it? By the way, I definitely relate to the UK phone snatching increases. It's crazy. It's so dangerous right now to just use your phone on the street.
Yes, it certainly is a dangerous time to be a phone user in public, which sounds like an absurd statement to say, but it nevertheless is the truth. And indeed, this type of crime was actually my gateway into this sector. I've been in technology for 30 years, but I had my phone stolen a couple of years ago. And while I wasn't a victim of a transfer mugging, I was a victim from the cards in my mobile wallet being used. And that took me on the journey to look at what protections we have on phones and where they could and where they should be in the future. So what I'll start is by saying that what Revolut have done here is one of the best implementations of protections around these sorts of problems that I've seen across all of the incumbent and newer banks. But to your point, what is a transfer mugging? Very simply put, it's when someone gets hold of your device either in an unlocked state or with knowledge of how to unlock it. So possibly they've seen your PIN at a prior time. They are then able to use the data assets and the financial assets on that device to credibly represent themselves as you to various financial, social media and other bodies. Specifically in this case, gaining access to the Revolut app, setting up a new payee, and then transferring potentially quite sizable sums from the victim's account to a mule account. The great thing about modern fintech and modern banking is that you can move large amounts of money very quickly, very seamlessly, which is 99.9% of the time. That is a great thing. The problem comes that with great speed and great ease, there becomes problems when you are not the person involved in that transfer. And the protections that are being put in place here definitely combat the two most common elements that are under Revolut's control. So firstly, setting the value. The minimum level you can set it to is £100, but go up as high as you feel comfortable, because different people will have different amounts that they feel are common for them to be transferring. And then less useful, but still useful, is the trusted locations element. So if you're, say, at home, at work, etc., having less restriction in those places will definitely give a better customer experience. All that said, it's a shame that there's a need to put friction in the middle of a process where there wasn't some before. I understand that it is a response to the current situation, but I would advocate for a frictionless situation during times of peace, with ways to prevent actions when you haven't got your phone following a theft. So yes, this is definitely the best version of this defense on the market, but I think there are reasons that people won't necessarily implement it. There are potential ways that criminals can circumvent some of the protections. And I think there is a bit of a way to go, but this is certainly a very good step. And I don't want the perfect to be the enemy of the good.
No, definitely. It sounds. I mean, and I just want to double click on one of the things you said there. I mean, what are the other types of ways of doing this?
I'm at the risk of scaring
in
people.
1 minute.
In 1 minute, okay. So your most common one is if they've seen a PIN code using cards in a mobile wallet to make payments. That is your bargain basement. Your crime. Secondarily, you've got adding yourself as a payee into an account. That's number 2. Level 3, using trusted communication, so WhatsApp, Facebook Messenger, email, to credibly represent yourself to a third party. So it could be a parent or a friend saying, "I've lost my phone. Can you please send John £100?" They're not covered there. There's myriad problems in the world of crypto. So my personal crypto account on my phone is very well protected through an unknown attacker. It's got a 35-character password, a 2FA code, SMS code, and an email password. But all of that data arrives onto the device that's been stolen. So if they have access to it, again, you think you're protected, but the reality is you're much less protected.
Yeah. And some of those use cases, I suppose, wouldn't be protected by this solution, because that is a situation where you are representing yourself as the individual and you are asking another person or another entity to pay me to a different account. And I don't think that this would stop that in
No.
some ways, because I think this is just exiting money out of your account.
Correct. The protections in place here protect the victim of the phone theft, not victims who are duped by the thief and they communicate to a third party. So there are levels to the crime. There are the basic ones that affect the victim. Then there are the people that are associated with the victim who are also affected. Could be employers, could be friends and family. And then there's the victim themselves further down the line through future ID thefts, because typically phones contain personal data required to set up new bank accounts and take out borrowing, etc., in that person's name.
Yeah, it's so interesting. I'd love to give the rest of the panels an opportunity to react to this. I'll tell you how I felt personally about this when I first saw it. I thought, this is very cool. This is very interesting. This is a little bit like when Apple released that satellite feature. I was a bit like, wow, like I can like communicate to a satellite. Like if there's no signal anymore, all of a sudden I get this kind of like access or this protection that I never got before. But I've never used it. I've never been abandoned on top of a mountain, and I've never had to use it. But man, it sounded really good. There's a creep factor to this. Maybe that the bank is able to understand my location. I mean, does that? I mean, I suppose the reality is that they are going to get that location data. Does that creep any of you out?
I have two sets of thoughts on this. The first is, my first reaction was exactly like you, David. This is great. One is, it's going to make things harder for people to actually like take money away from you. But also, it's almost kind of creating a deterrent, right? The ROI for phone thieves is going down. So you know that the proportion of phone thefts that are actually going to lead to them being able to transfer money perhaps might go down, and then that kind of changes behavior pattern. So that's one way. But my second reaction was immediately thinking of like all of those random James Bond movies where they actually have an eyeball or like somebody's thumb that they used to do it. And I'm like, if the standard method doesn't work, are they going to try to stalk me to my house to use that address and then transfer from there? So it's a question of how you look at it positively or negatively. But coming back to the point of the geospatial tracking and location tracking, a lot of banks are already using data around geographical locations to monitor fraud or to figure out whether some behavior patterns from customers are unusual. And you already have models that say that if Aditi has bought a coffee from, I don't know, Starbucks 5 times, why is she suddenly going to a Nero in a completely different place? So there is some element of that already incorporated, which doesn't manage privacy. My biggest sort of reaction to this on the positive side, though, is it is an excellent example of how philosophy around tackling the same problem changes between banks. Now, all of these newer banks, these challenger banks and digital banks came in with the premise that customers are not getting the same service from established banks, and we're going to do something different. So they made it all digital, they made it all frictionless, like James said, and so on. But to this problem, Revolut took the approach of saying, okay, if phones are being stolen, we will manage it differently. We will kind of slow things down. The approach that Marcus took, for example, to prevent like illegitimate transfers is to say that you can only transfer out to a single account. So they're already putting a constraint, making their own financial crime monitoring simpler by saying we only give you a limited set of service, but we're doing that to keep you safe. Whereas Revolut has said you will get the full service, but we might add friction and make things difficult if you need that. And it is a very different way of looking at what your customers might need. So that was an interesting aspect of it all for me.
It's such an interesting thought because it matches Revolut's design philosophy.
Exactly.
In that they are, and this is also potentially why their valuation is so high and potentially one of the reasons why they earn so much money out of fees, et cetera, et cetera, et cetera, is that their whole view is that we are not a bank. We are something else, and that something else is an application, it's software, it's lifestyle, it's all of these other things. And I think you've really picked on something very interesting in that their reaction to security here seems to be a very we are not a bank wave of doing it. We are a service. We are going to look elsewhere because we can look elsewhere because we are a technology firm, not a bank. Whereas actually, as you say, Monzo and Chase and all of the others are still, they are taking kind of bank views, finance views on how you would solve the problem. It is interesting because when I saw the press release on this, I thought, that's very Revolut. There's just something very Revolut about this, which just kind of makes sense.
The other angle there is sometimes we get so hung up on this whole personalization and customization and give my client what they need problem that we kind of miss the reason why your client might want something. And again, this goes back to the point you made. This is a very Revolut way of doing things. They are not changing anything for me versus you versus Virginie. They're finding like a bigger problem, which is a lot more societal and systemic almost. There is no personalization about it. It applies to the whole of London. But they're still doing something very intelligently about it. And it's almost like you can still get that loyalty. You can still get that wow factor by doing something which is not personalized at all, but it is still an important service to provide.
Yeah, I think what they've done actually is quite personal because the locations that you're picking, they're personal to you. That you want to trust, the amount that you're putting as your threshold for things to kick in, that again is very personal to you. You can set it up differently across commodities, crypto, cash, etc. So I think there are lots and lots of very good tailoring options in there to make it personal. Where I think Revolut can't do better on their own is that, yes, they're going to make Revolut customers safer. That is a finite statement. The problem is the thief doesn't know that you have a Revolut account before they steal your phone.
That's true.
So the risk of the theft will persist while the majority of providers don't have this or similar protections in place, because the ROI on stealing a phone is frankly phenomenal. It's well into the four figures.
You're right, and that's kind of a nice circle back to what I said in the end about the satellite thing with the iPhone, is that the vast majority of people are not lost on a mountain.
No.
Right? However, the idea persists. So we could keep talking about this because it is very interesting, but I just want to say at 11FS, we like this so much that we actually did a video on how banks and particularly fintechs think about developing services like this called Digital Riches. And we've included a link to an Explores video in the show notes below this episode that breaks it down into more detail. So if you want to have a little bit of a peek into how product teams think about developing services like this, take a look at that video. All right. On that note, we're just going to take a quick pause here and back shortly.
This episode is brought to you by Indeed. You're ready to move your business forward, but first, you need to find the right team. Start your search with Indeed Sponsored Jobs. It can help you reach qualified candidates fast, ensuring your listing is the first one they see. According to Indeed data, sponsored jobs are 90% more likely to report a hire than non-sponsored jobs. See the results for yourself. Get a $75 sponsored job credit at Indeed.com/podcast. Terms and conditions apply.
While the Whos of Whoville were laughing and eating, the Grinch from his lair sought to wreak havoc on their season. He thought, how do I ruin their holiday meals? A plan sprang to mind, which he enacted with zeal. Dill pickle seasoning on fries will make for a green surprise. And I know they'll be shocked with these loathsome odd socks. So if you want to experience the Grinch's mischievous meal, head to McDonald's and show him how you really feel. The new Grinch meal, now at McDonald's. At participating McDonald's while supplies last. Ba-da-ba-ba-ba.
Now, a quick break from the headlines to spotlight our latest Insights episode. We are diving back into stablecoins, but this time we're focusing on the practical side, regulations. They might not grab the headlines, but they're crucial to getting ready for the next wave of innovation. So in this episode, Benjamin Ensor is joined by Formance, along with representatives from Fireblocks and Worldline, to unpack what fintechs, platforms, payment providers, merchants, and corporates need to know right now. So if you're looking for the shortcut to becoming stablecoin ready, this episode is your go-to guide. Find it on the same feed as this one. Right, now back to the news. And our next story, this one is from Finextra. FCA aims to rebuild trust in ESG ratings. The Financial Conduct Authority, FCA, has launched proposals to regulate ESG ratings providers, aiming to rebuild trust by setting new rules for transparency, governance, and oversight. The move responds to widespread concerns over poor reliability, lack of comparability, and opacity in how ESG scores are calculated. FCA research found roughly half of ESG ratings users are worried about how ratings are built. That's 55%, that's really high. Or how transparent they are, 48%, also really high. Under the draft framework, ESG rating firms will have to follow stricter standards around disclosure of methodology, governance, conflict of interest management, stakeholder engagement, and complaints handling, aiming to make ratings easier to benchmark across companies and funds. The FCA says these reforms, expected to come into effect in June 2028, will strengthen market confidence, support sustainable finance growth in the UK, and enhance the UK's reputation as a global hub for ESG investing. So first off, I relate to this. Like I'm sure a lot of you do. I find these reporting numbers. I mean, you just look at my investing app, it gives me an ESG rating. I don't have a clue what that means. Virginie, let's go to you first. Tell us what are the FCA doing here?
I mean, well, so ratings have been a big issue for a long period of time in the ESG realm, largely because it's such a subjective area and it's very heavily influenced by politics. I don't know if anyone's noticed, but across the pond, we've got quite a lot of pressure to move away from ESG. So it's become an immensely politicized topic. So the concept of having sort of neutral data providers is sort of in the US maybe not actually viable. So in the rest of the world, there's certainly a lot of discussion about how do you make this data more transparent, reliable, accurate, all of the things that you have to sort of feed into things like trading decisions or long-term investment strategies and things like that. So certainly there's been a lot of pressure and requests on all of the regulators, not just the FCA, but all of the global regulators to crack down on benchmarks and ratings. And now in the traditional world, benchmarks and ratings providers are heavily regulated. Just in the ESG world, it hasn't been the case for since its sort of inception, largely because it's such a fast evolving area, and the actual data sources and how you're using those data sources changes over time. Because if you think about how you're breaking these three things down, environmental data could be everything from satellite information about particular areas and how much CO2 is being outputted by a particular factory, through to it could be anything to do with I guess the governance side of things is the G. So that's how companies are being governed from a transparency perspective of how much you're paying your directors, what kind of balance of directors do you have, all of that kind of thing. And the social equally in terms of equal pay, gender parity, all of these other things that feed into these various aspects. So there's been a big focus on the E, so the sustainability aspect, but the G has been there long term. But the S has been slightly less well regulated, if I would say, in terms of how much information is out there. And obviously, a lot of the US companies now are reporting this information, but are coming under scrutiny from the government there in how much data is coming out. So there's a lot of pressure on the data providers and the ratings providers to get this data in the first place. It's not actually easy to get some of the information, and it's not very comparable. So you're pulling a lot of information from unstructured sources, as I said. So it could be anything in the world with regards to you can have lots of unstructured data sources. It's not like traditional reference data that you're sort of reliant on within the financial services world. So I understand the regulators want to try and make it more stable and is structured, but that is not an easy thing to do with something that's so heavily politicized.
Yeah, because that was going to be my kind of follow-on question is like, can they actually get to there they want? If it's so difficult to measure and get reliable data sources, is this going to be possible?
Well, ratings are very subjective again, so that's why you've got such a lot of variance. And they're very much looking at conflicts of interest is important because the G bit is the governance bit. It equally applies to the ratings providers themselves because obviously they provide a lot of data in other areas. They may be providing other services related to this. So you really want to make sure that they are, Chinese walls are in place. They're sticking to the letter of the law. That there's no potential outside influences on that data being produced. So certainly that is, one of the tenets. That's, common sense regulation, I would say. But the other aspects are probably harder to assess because it really depends on the analyst that's making those ratings decisions as to the inputs that they're gathering. So there is still going to be a high degree of subjectivity. There's still going to be variance, and you're still going to have preferential data. So, if you're an asset manager, you may want to work with a particular provider for a particular reason, and somebody across the street from you might be using someone else for a completely different reason. So I don't think it's an area that is going to be totally standardized, but it's something that did need to be regulated.
Yeah. What does everyone think about this?
I think you've got a problem. Not a problem. Well, there is a problem where you're trying to compare companies using a single scale that are entirely different. So a very well-run factory will always use more power than the worst staffed office. And if you're looking to get a standardized set of reporting metrics that fit for everybody, I don't see how you can have a meaningful comparison between entities that are so disparate. So for me, it felt like, as a consumer and not someone who's particularly up on the ESG world, I don't see the value in putting everything into one scale. If I want to look at my bank's ESG, I want to compare it to other banks. I don't want to look at it versus automotive manufacturers, because that's just not a comparison that's useful. And if you start doing it on a more targeted, like this is my services firm ESG rating, you then start to get numbers that do make a lot more sense. And I think that is the goal here, is that you can make an objective interpretation of what you're seeing about that business. And I think trying to do it as a one size fits every business will only ever lead to a set of compromises that you wouldn't need to have if it was industry specific.
I mean, ratings providers do industry specific ratings. So just to make that clear, they're not comparing apples to oranges.
I do not know what I'm talking about.
Don't worry. No, I mean, it's not common knowledge, I don't think, but certainly they make different inputs and different decisions, right? So the transparency is the important bit. They're not always going to be coming out with the same ratings. I think that's the issue here.
But your perception, I think, is accurate, James, in terms of how a lot of people see these ratings. I think it's important. Aditi.
So on the point of perception, the way I see it is making investment or lending decisions on the back of ESG ratings is like buying a house in London based on what you see on an estate agent's website.
Mm-hmm.
Like that is how reliable it is, right?
It's always a lie.
It's always a lie. There are some numbers, there are some metrics, some of which might be verifiable, most of them are not. There are some pictures which look completely different from when you actually go and see the house. And the problems across these are very similar. So I almost think of it as a three-phased process. And ESG data, ratings, monitoring is a huge use case in the AI space. And that's one of the biggest application sets in the FS space for AI. But the three columns, one is acquisition of data. So this goes back to what Virginie said. So many of the sources are unstructured. They are so hard to verify. You might have a valuation agency walking in with a dampness counter. You might have like some mine in Africa demonstrating that the humidity is enough or not. So that unstructured data acquisition piece is a big problem. Now, a lot of that is still physical data, which is hard to solve with technology, and it will continue to be a problem. But the second piece is, once you have actually collected the data, historically feeding that into any kind of system which could actually interpret it was a challenge But that challenge is now slowly being solved with AI. So if you get me the data, then I can ingest it, I can make sense of it, I can process it. So it's at least within the first vertical, 2 parts of the problem. The second one is getting solved bit by bit. The first one, still a problem. The second piece, which is the interesting piece here, is that interpretation of data. And again, I have actually met with startups whose sole purpose was to create an interpretation of the fund reporting rules as the regulator specified them, but as they would apply to the investment and so on. So not even creating a rating, but interpreting the rules was their only job. And I think in that space also, the more data we have, the more patterns and trends we can figure out, the more we can determine what the impact of those trends and patterns are, and the more consistency we can apply. And James, this kind of goes back to your point. We can create those differentiations as they are appropriate, but we can always create a shared language, a shared set of benchmarks, which, whether you're a company or a regulator, whether you're in the UK or the US, it's the same language that we speak. So that's the processing or interpretation problem. And then the third problem is what that actually means, like the so what of it. Okay, so what if you have a certain ESG rating? Are we actually then going to create enough either regulation or market resistance/demand to only fund, buy, or invest in stuff that has good ESG ratings or not? And that's where it ties back into Virginie's point around the political issues around it. So I think the ESG problem, again, has the evolution, but from my biased view, the fact that we are getting so much better at managing that data is definitely changing things in the space.
And all of that kind of put together, if the FCA, what they can achieve through this is maybe just a little bit more transparency, which was what Virginie was what you're saying. Like ultimately, this comes down to transparency. It's like then that is better. Because you sort of noticed this rollout across the internet. There was all this controversy over Meta's fact-checking. If you remember when Trump came in, Zuckerberg was like, we're not going to do that anymore. We're going to fire all those teams. And then, Elon Musk made a big deal about Twitter and whatnot. But I was actually on X the other day, and the fact-checking is pretty good. They believe it or not, you'll have some article that will say something crazy and there'll be this long thing being like, actually, this is factually incorrect because of this reason, that reason. It comes down to transparency. I'm not telling you what to value, but I am giving you some data and some information that is going to maybe improve how things go. So yeah, I think this will be an interesting one to see.
Fact-checking as a topic is actually inherently difficult because the half-life of a fact is something like 7 years. So you can be completely correct on what you're saying today, but the chances are that half of the things that you're correct on today, the same thing will be wrong in 5 to 7 years.
Yeah,
it's all a matter of interpretation, I might say, right? Depends on how you look at the world as to what's a fact and what's not these days.
and that, Virginie, is political, right? As you said. So yeah, it's very, very fascinating one to watch. Final word on this, Virginie. Do you know what the timeline is on this? Like roughly when this is due to conclude and happen?
I believe it's next year. And it's part of a wider program of work. So there's going to be more consultations, I believe, on the ESG topic going forward, because sustainability as a theme is very big in Europe. It's not going away anywhere.
You're right. Over the next few years. Makes sense. Okay, brilliant. Right, and now on to the next article, and this one is from Finextra. Wise enters Africa. Wise has received its first regulatory license in Africa with conditional approval from the South African Reserve Bank, that's SARB, to operate as a Category 2 authorized dealer in foreign exchange. This license will allow Wise to offer cross-border money transfers to personal customers in South Africa, giving users access to international transfers with greater speed, lower cost, and giving more transparent exchange rate pricing than many legacy remittance services. The move fits into a broader context. South Africa, which is a G20 member, has committed to the G20 roadmap for enhancing cross-border payments, which aims to make global payments faster, cheaper, and more transparent by 2027. With this approval, Wise expands its global footprint, joining a network of 70-plus regulatory licenses worldwide, signaling its ambition to become a truly global payments infrastructure provider. So to tell us more about this, we have a voice note from Nadia Costanzo, Director of Banking and Expansion at Wise.
Recently, we announced that we received our first regulatory approval in Africa. It's a conditional approval for an ADLA 2 license in South Africa. This marks for us a really exciting milestone as it's our official entry into this dynamic region as a regulated institution. So while we've been allowing people to send money to the region for years, this is significant as the license will actually allow us to offer products locally so people can finally move money from the region to around the world. It's a foundational step, which for us is crucial to expand our mission to a region that really still suffers from extremely high costs and lack of transparency in international payments. In South Africa, the average cost of sending money is exorbitant at 7%, while Wise's average global cost is 0.54%. Our relentless focus on bringing down costs allows us to save customers £2 billion per year. So our goal is to bring these savings to even more African customers by building the most solid local infrastructure. And this can really only be done by getting these authorizations in local markets and building products designed with the local customers in mind. You would have seen that we've been doing this across the Middle East and Africa region. Just a couple of months ago, we've also received our licenses to operate in the UAE. And we're really committed to keep the momentum going so that customers everywhere can continue to have access to fair financial services.
I mean, Wise are just kind of killing it a little bit, aren't they? They're a little bit like Revolut in that they and I suppose Revolut did also start from Forex. So there's that kind of, there's that relation there. So that's interesting. But like, I just keep seeing them do all of this stuff. You can kind of see where they're going, which is a very Revolut-like direction in some way. I mean, anyone have any thoughts?
I was shocked when I read this that it wasn't a thing already, because my brain from the early noughties going forwards was that money sending services were predominantly from the West to Africa, and therefore I thought this would have been like day one for people like Wise to have this in place. And it was only when you had the explanation that actually sending money in was fine, but it's sending money around and out, that this made more sense. And I think that is showing how certainly South Africa and other more developed African nations are now forming part of. I mean, South Africa is in the G20, and the fact that they now need services to move money in the other direction is a sign of their growing relevance on the global stage.
Yeah, and I think exactly like you said, David, it's interesting to see how Revolut and Wise sort of originated with the same seed idea of the FX transactions and cross-border payment transfers and so on. Wise has very much doubled down on that offering set. Revolut has very much gone on we want to be the bank and do so much more than just the transfers. But especially from that perspective, if you look at it from Wise's point of view, it's an extremely strategic means to an end. And I say that because they are increasingly moving from a consumer-only offering to more of an SME commercial corporate offering. Now, if you are a corporate, and like this is me with my old like FX payments hat on, if you are a corporate, your objective is to find a partner or to find a platform that can service as much of your cross-border needs, whether that is payments, whether that's liquidity management, whether that's any kind of like local banking for your subsidiaries, as you can. So the more distribution and the more spread you have, the better it is. So therefore, a lot of these banks, like if you look at the cross-border payments offerings across Deutsche and JP and so on, they all talk about 120 currencies, 140 currencies, of which we can do 82-way, 121-way, and so on. So for Wise to establish that global presence and coverage, just like was mentioned earlier, they've tackled the Middle East, they'll tackle Africa, then they'll sort of tackle LATAM and so on. But from an Africa point of view, then let's assume, okay, we need to get into Africa, we need to establish presence there. How do you go about it? And then South Africa becomes a very obvious choice for quite a few reasons. So the first one is, like we said, there is already that drive to push the costs down. You want to go from 7% to ideally the World Bank SDG stipulated 3% and even lower. So you will have the necessarily lean in from the regulators, from the local infrastructure, from the powers that be in the market. The second piece is, as a foreign exchange market, South Africa is one of the most traded emerging market currencies. So across the African region, most other currencies are non-deliverable. They're restricted markets. So the inflow is fine, the outflow is not. So South Africa is an obvious choice. And then the last piece of it is, from an overall banking system maturity, I was going to say rule of law, but you can't really say that blanket about South Africa, but more from like how the banking system operates. It is a much more mature market than the rest of the space. So it makes sense for Wise to use that as the stronghold, like the first place they go into, build out from there, and then add on other markets over time once they have established their presence in Africa.
From my perspective, obviously, because I cover capital markets, it's quite a well-established and quite mature capital market as well. So certainly a lot of that sort of the corporate world and the money flowing through is definitely significant within South Africa. But I think if we look at it from the tech provider perspective, I would say, looking at the African region overall, the Western firms have been very far behind the Eastern firms in terms of establishing footprint. So, I think we're sort of playing catch up here, aren't we, in terms of trying to get into various African markets where we're quite a few years late to some of these things like Alipay and all of that kind of stuff that's been making headroads for a long while.
It's actually such an interesting point, Virginia. I'm glad you raised that, because the story is not about, oh my God, now South Africa is a thing. The story is more about Wise and how they're expanding, because, as you say, there's a couple of examples. There are lots of competitors already existing in South Africa that do this kind of stuff. So there's Mukuru, there's Mama Money, there's Exchange for Free. There's lots and lots of different. I'm sure there's as you say, there's Alipay. There's way more other types of services there. It's probably more, I think, as you were saying, Aditi, for the sort of feather in the bow for the corporate clients they have when they're trading in the rand or having a subsidiary or something in South Africa. That makes a lot of sense. It is very interesting. We don't cover Africa enough in the podcast. It's very interesting to see Africa's kind of growth overall. I mean, there's other countries like Nigeria and Kenya, for example, Egypt, which is growing like crazy. James.
Yeah, and this could again be my ignorance of the topic, but given that all I'm hearing from other institutions is the move to stablecoin settlement as how things are going to go for moving money in the future. Why is it important for Wise to be locally regulated in rand-denominated accounts when I would have assumed they could operate at a stablecoin level for their international outflows while keeping the rand local for any inflows? I've probably not articulated that point very well, but
I like it. I mean, because that might be what's next. I think stablecoin is one of those things that's very interesting and growing in traction, but is still overall a very, very tiny percentage of the overall cross-border flows.
For Wise, that might be an interesting thing, though, because I would say across the economy, there would be very few South African businesses, for example, or SMEs who would think of stablecoins to make small transfers or remittances in and out of the country. So to David's point, it is a very small percentage. But specifically for Wise, who have historically targeted a client base of relatively financially literate, relatively digitally savvy, kind of like digital nomads and people who know what they're doing with their money, that might well be an angle that they use to differentiate themselves from the local providers that you mentioned earlier, David, because the local providers are all very cash-based, physical infrastructure related, like kind of Western Union versions that exist at the moment. And this could perhaps be a competitive advantage for Wise to say, we could take you all the way from here to there as a value proposition.
The only point I was going to make there was with regards to central banks and stablecoins. Not every African region is on the same page with regards to their appetite for allowing stablecoins into their country. So just a note on that.
Awesome. Right. And on that note, we're going to take a quick pause here and back shortly.
Get Popeye's Scary Good Freddy Fazbear Box with garlic palm tenders and cheesy bites with marinara sauce. Or try the deluxe box with the Cupcake Cup and a 20-ounce drink and see Five Nights at Freddy's 2, only in theaters. Love that chicken from Popeyes. Limited time at participating U.S. restaurants.
Okay, now for a quick look at one story we don't have time to cover in full. And this one's from Finextra. Visa in digital wallet push across Europe. Visa is rolling out a new digital wallet initiative across Europe, partnering with BBVA in Spain, Klarna in several countries, Vipps Mobile Pay in the Nordics, and preparing a pilot with Bancomat in Italy for early 2026. The expansion is enabled by the Digital Markets Act, which now allows third-party wallets to access NFC technology, increasing competition and flexibility in mobile payments. Visa highlights strong demand for mobile payments, noting that 59% of European e-commerce transactions already use mobile payments, a figure expected to reach 75% by 2030, with nearly 1/3 of consumers planning to rely solely on mobile wallets. Visa Europe's leadership says the initiative is a major step towards giving Europe more choice, competition, and innovation in mobile wallets. So, as James very kindly pointed out in our little coffee break we had as a team, I think a lot of this is probably due to, exactly as it says here, the Digital Markets Act, which is allowing openness to access the actual NFC core technology. So Apple made that change, I think, earlier in the year, and we're just seeing lots and lots of people develop their own mobile wallets and encourage people to use them because they don't have to pay so many interchange fees. They can get the revenue back for them, and it all makes sense. All right, finally. And this is called FinTech or Cricket. It's time for something a little bit different to wrap up this week's news show. While we usually stick to FinTech headlines and market moves, there's a surprising amount that FinTech and cricket have in common. Believe it or not, who knew? Who knew these were two things? Not least a shared love of impenetrable acronyms that leave outsiders scratching their heads. So in the spirit of combining our two passions, and with the biennial Ashes tournament now underway in Australia, we thought we'd pick a quick round of FinTech or cricket. So, can you guess which world these acronyms belong to? I'm not going to start with the first one on this. Our listeners can't see this, but we have a cricket expert on this panel. So I'm going to. What about ODI?
Cricket.
Cricket.
This is a nature versus nurture kind of debate for me. Like, I'm an Indian and now I'm in FinTech.
Yeah,
so.
well, I don't. Yeah, so actually, yeah. This isn't an issue for most of you on this panel. What does ODI stand for?
One Day International.
Okay. Wow. Okay. DRS, what does that stand for?
That is the decision review system in this context, not the drag reduction system of the F1.
No. That's a different sport. Lots of FinTech with F1, by the way.
Yeah.
James, what is AML?
That is anti-money laundering.
Is PSD2 position stump? What's the D?
Payment Services Directive. Come on.
No.
Position.
I'm trying to cricket it, Virginie. I'm trying to cricket it.
Come on, you can't. What has to do at the end of it?
You can't.
It's your second positive square drive of an innings.
There we go, James. Now make that a thing. All right. We are very much over time. And so thank all of you for attending today. Where can people find out a little bit more about you and your company's Adity?
LinkedIn is the best place to find me, and the Snowflake website is phenomenal. So please go and look it up.
Amazing. And James?
I'm also on LinkedIn. You can find more about Nuke from Orbit at our website, nuke.app. And if you're a fintech business that wants to protect your assets, we would love to support you on that journey.
Amazing. And Virginie?
If you like FinReg memes or memes in general, you can look at my profile on LinkedIn because there's loads of them on there. And you can also look at www.fintechfirebrand.com for our research.
Amazing. I am now going to dive into that FinReg meme rabbit hole. And as for me, you can find me on LinkedIn at DavidBG. Thank you so much for listening to today's FinTech Insider. If you like what you've heard, please make sure you follow us on your favorite podcast platform of choice. And if you really like what you've heard, why not share the podcast with a colleague or a friend? As always, if you want to join the conversation, find us on social media. Just search for 11FS or FinTech Insider or email podcast@11fs.com. Thank you very much and goodbye.
Hey, Ryan Reynolds here. Wishing you a very happy half-off holiday because right now Mint Mobile is offering you the gift of 50% off unlimited. To be clear, that's half price, not half the service. And Mint is still premium unlimited wireless for a great price. So that means a half day, yeah? Give it a try at mintmobile.com/switch.
Upfront payment of $45 for 3-month plan, equivalent to $15 per month required. New customer offer for first 3 months only. Speed slow after 35 gigabytes if network's busy. Taxes and fees extra. See mintmobile.com.